Hello, everyone. It's Thursday, August 18th. Welcome to the Final Bar. Today's guest is Jeff Huge from JWH Investments. A couple of really interesting charts that certainly made me think as we were talking about them before we went live here with the show. We'll talk about this choppy market environment. All eyes on resistance. Stocks like Apple moving right up to previous highs. Stocks like Ross Stores and Starbucks and even the S&P itself bouncing up to the 200-day moving average. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny and warm Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using the toolkit of the technical analyst to better understand investor behavior and look for actionable ideas in the investment markets. A lot has been discussed about the challenges of the S&P, the NASDAQ continuing to push higher as we've reached resistance, but we've met resistance before in the last 6 to 8 weeks, and we've powered up through them every time. Is this time a little bit different? And potentially, right? And I think the differences are the major averages, the S&P overbought, actually came out of the overbought region earlier this week, if I remember right. A lot of individual names, particularly in the growth areas like technology, overbought, a lot of them bumping up against key resistance levels. I've often said in this sort of environment, whether you're bullish or bearish over the longer term, a pullback is probably going to fit into either one of those narratives. And that's probably why I think it's reasonable to expect when a market's had a run that it has, that it pulls back. The question is how deep we pull back. And I think that could tell us a lot about what might be coming next. Now, we have a great guest on today's show, Jeff Huge. He's a frequent guest on this show and also does a great job elsewhere on Stock Charts TV on shows like The Pitch. I'm really keen to get his take on what's happening. We have some really good guests lined up for you next week, by the way. On Tuesday, the 23rd, we continue this power technical analysis from Minneapolis trend with Craig Johnson from Piper Sandler joining us on Tuesday. On Wednesday, the 24th, David Auerbach, who focuses on real estate, REITs. On Thursday, the 25th, Tony Dwyer, one of my favorite macro strategists from Canaccord Genuity in New York, get his take on the Fed, inflationary pressures, recessions, and all those other good things. A couple events to let you know about. I'll be doing my next webinar with market misbehavior coming up next Tuesday, August 23rd. That's at 1 o'clock Eastern. It's called Seasonal Struggles for Technology. We will talk about how August and particularly into September tends to be pretty weak for technology on a relative basis. Also not great for the major markets as a whole, the NASDAQ and the S&P. We'll look at the evidence and talk about what the current charts are telling us relative to the seasonal trends. You can go to marketmisbehavior.com/technology to sign up for that free event. Also, ChartCon 2022 is happening October 7th and 8th. We are bringing a number of presenters out to our new studio in Redmond, Washington. This is hopefully the first of many really cool things we do at our brand new studio that is just being finalized right now. Some fantastic presentations by Larry Williams, by Linda Raschke. Today, I want to highlight our live trading rooms. We have Aaron Swenlin from Decision Point, Dave Landry from DaveLandry.com hosting live trading rooms during the trading session on Friday the 7th. You can see what they're looking at, hear when they're making decisions, and think about risk versus reward real time. For that event, go to StockCharts.com/ChartCon. If you're a member or if you take a free trial, you get a major discounted rate. So make sure you do one of those things today. Let's continue on today's show with our market recap. Let's talk about how these markets have evolved. I described this the same way I've described the last couple of days, pretty much choppy. I think that's the phrase. I'm trying to think of one of my guests months ago had talked about the sloppy chop, and I feel like that's kind of where we're at. We had the big run from mid-June to mid-August. Now we're sort of stagnating a little bit. The last couple of days traded right up to the 200-day moving average, and now we're stalled out a little bit. Now, having said that, there are sectors like energy, which are actually rotating very, very nicely. Some individual stocks that are certainly making new highs, stocks like GPC and others come to mind that are making new 52-week highs, regardless of what else is going on. HR&R Block, HRB is another example of those stocks making new highs. But the major averages driven by the growth sectors have stalled out a bit. At the end of the day, the S&P finished about 0.25% above yesterday's close, just above 4280. The NASDAQ composite just below 13,000, up about 0.25% as well. Mid caps and small caps both outperformed the S&P today, with the small cap index up 0.8%. And I always remind people, if you think of the equity markets as the S&P 500, that's okay, but you're really limiting your exposure to a lot of potential opportunities. Make sure that you broaden out your screens and look at what we would call the S&P 1500, including mid caps and small caps, at least, if not even more names, and just look for opportunities, because a lot of times there are movements in small caps that may not be reflected in their larger counterparts, but a lot of times can give you good opportunities for outperformance. The VIX, by the way, a little bit lower today and back below 20. We'll look at the chart of the VIX along with other things a little later in today's show in our segment on sentiment called Getting Sentimental. So we'll come back to it then. Interest rates coming off a little bit. My conversation yesterday with David Hunter certainly got a lot of reaction on social media and in our comments section on YouTube. He had some pretty crazy projections about where markets could go. And what I've told people when I hear things like that, for me, I don't have any positive or negative reaction. My main reaction is appreciation that it's stretching my thinking a little bit. I like thinking about severe bullish and severe bearish scenarios because it helps you think about is that actually possible? How would that play out? What would this portfolio do in this environment? So having said that, we talked yesterday about the prospect of much lower interest rates. Interest rates coming off a bit today, right? With 10-year yields down below 290. Dollar index, by the way, up a little bit using the UUP, which is up about 0.8%. Commodities mixed overall. Gold and silver continue to show weakness. The dollar obviously being stronger today is not particularly helping that. When I'm looking for stocks making new swing highs and new lows, my new swing lows list often has some mining names in there, some gold stocks. Royal Gold came up there today. Wheaton, I want to say, was on there as well. Those tend to be pretty consistent. Again, the gold and gold names have not been particularly well. If you are buying something like a gold stock here, as far as I could tell, your main justification is it's gone down a lot. And I've learned that prices go down for a reason. And just because something's gone down a lot on its own is not a great justification to buy something. Look for additional validation that it might be a good entry point on those names. And that can maybe be a little more helpful. Bitcoin flat from yesterday when we were doing the show. Trading higher through the earlier in the day, but then coming off as we were getting ready for the show. Ether actually stronger through the course of the day, up around 1870. And one of the ratios we talked about yesterday was the ratio of Ethereum versus Bitcoin, which has matched the S&P 500 beautifully. So if you haven't looked at that ratio, I would encourage you to take check that one out. I hadn't really seen it until recently, and I think it's certainly an interesting corollary to what we've seen with stocks. Having said it, just to set the stage, I'm going to talk with Jeff Huge here a little bit after the break about the S&P. So I don't want to beat it too deeply, but just to set the stage for that conversation, the S&P has run very, very nicely from 3650, a little bit below that, to just almost 4350, currently around 4300, just below that. We reached the 200-day moving average on an intraday basis 2 days ago, and from there, have kind of pulled back a little bit. This is right at that key moment. Do we have enough momentum to power through resistance and continue this trend, or do we pull back from here? Either one of those is certainly possible. What concerns me about the bull case from this moment right here is that stocks have run so much. The S&P overbought. A lot of NASDAQ names overbought. A lot of stocks hitting their own 200-day moving average or hitting significant resistance. And Apple is maybe an example we'll talk about here in a moment. I don't feel great about the market just continuing higher when we've already had those signs of the market running too far too quickly. Having said that, the big question is, where do we go from here? And again, a little later, I'll talk with Jeff about his perspective on that particular question. I mentioned Apple a couple of times. I think Apple is a great illustration of the challenges with this current market. Impressive return from 180 down to 130, back up to 180 on an adjusted basis. We're a little below there, around 174 right now, but sort of within a rounding error of the highs from November, December, and then March, April. It's an impressive run to round trip all the way back to those previous highs. And obviously, it's been one of those leading names. A lot of stocks, not even near their 52-week high, and Apple managing to push its way, further to the upside. But here's the challenge with the market going above there. It would have to overcome significant overhead resistance. We're now bumping into where we topped out at the end of last year. This is the same place where Apple stalled out in that March rally. This is when the S&P stalled out at 4,600 and rolled over, kind of right at that same point right here. So do we have another sort of set of scenarios where Apple hits its previous high, struggles to get above there while the S&P is attempting to get above its own resistance level? The lack of Apple and names like Apple powering through resistance is what really prevents the major averages, the S&P and the NASDAQ, from pushing to the upside. Certainly a possibility at this point that I would be paying attention to. We've highlighted some of the charts within energy. And I just want to point out again, energy, the top performing sector, and it wasn't even close, sort of energy and everything else today. Charts like DVN we've highlighted, and I'm super impressed by the bounce off of the 200-day moving average, the rotation higher. So after a couple tests, getting above the 50-day, breaking above the July high, and now pushing and making a new swing high yet again today, up almost 6%. The momentum is what's most encouraging to me. So while a lot of technology names getting overbought, maybe coming out of that overbought region, indicating an exhaustion to the uptrend, things like energy are actually showing renewed strength, actually showing that they're getting out of that bearish momentum territory and back into a bullish momentum territory, potentially. I think that's an interesting space to watch as you have some of the growth sectors which may be stalling out here. Let's take a quick break. We'll be back with today's guest, Jeff Hughes. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close to join us for our show. A couple quick announcements before we get to today's guest, Jeff Hughes. First off, we welcome your feedback on our show, on our guests, on your host, anything you see on StockCharts TV, but we very much appreciate your questions. We are here to help point you in the right direction as you are trying to use the StockCharts platform to understand technical analysis and to apply technical concepts to the current market. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions together. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That's our on-demand platform. We are so fortunate to have really knowledgeable, thoughtful, expert opinions and perspectives. People like Jeff Hughes, Tony Dwyer, Craig Johnson, so many others. As well as a lot of great special events like The Pitch, our mid-year market outlook, which came out last week, and so much more, all for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Jeff Hughes. Jeff is the Chief Investment Officer for JWH Investments. Always does a great job with StockCharts TV, sharing ideas and perspective. Jeff, it's good to see you again. Welcome back to the show.
Great to be here, Dave.
So we are at an interesting moment. I feel like I could have said that at many times, but particularly now, right? The markets have run so aggressively from June to August. And the question now for many investors, what's next? How would you answer that question?
Well, the S&P 500 has rallied into a difficult level, as you pointed out. It caught a bid at the 200-week exponential moving average around 36, 37 or so, and now has rallied into the 200-day simple moving average. But that level happens to coincide with the descending trend line off the March and January peaks, as well as the 618% retracement. And my view is this: if the market can hold below that, cadre or confluence of resistance, overhead supply, if you will, then, this is a bit of a Shakespearean tragedy in the making here. And my sense is that we will see a fairly big, reversion back down toward the lows, or retest of the lows. There's a number of open chart gaps. I've marked 4 of them. And much the way that we filled the gaps from June and May, I don't see how the market can continue to power forward without coming back and at least testing at least a few of these gaps. So, we've got an open mind here. If the market does break out sustainably above that 618 retracement, then I think we need to consider the possibility that at least a cyclical bull market has been underway, and we could reach some level of new highs, not necessarily a new all-time high. But if we do retrace back below the 50-day moving average, then I think we have to open up the possibility that the market could make a lower low this fall. We do have a negative divergence forming on the momentum study in the lower panel here, and that gives us at least some insight that the market's momentum is waning and appears poised to at least rest for a while, if not check back.
That's really, really helpful, and I appreciate you highlighting some of those particular levels in terms of where we might retrace to if that comes to pass. Now, breadth is obviously a key story, and the breadth had been so weak going into June. What are you seeing now alongside breadth?
Yeah, there's no question that the breadth story is the bull case right now. The statistical, percentage of stocks trading above their 50-day moving average, for example, is incredible, above 90%. You don't see that very often. It oftentimes does coincide with new bull markets, but not always. And one of the things that we're looking at here is when we look through the lens of various indexes of cumulative advanced decline for the S&P 500, for example, the NYSE, and the NASDAQ composites, we see completely different stories. The NASDAQ has this, that's the lower panel. It has, a lot of secondary stocks, very weak stocks, not fundamentally great companies. We would consider that like a house of straw. The whole story is kind of like the three little pigs, right? The NYSE gets a little bit better. You've got, a lot of dividend yielding stocks, preferred stocks, closed-end funds in there. It's made some progress, more progress than the NASDAQ, but it's like a house of twigs, right? But when we look at the S&P 500, the cumulative AD line has made a new all-time high. And what do you have in the S&P 500? America's creme de la creme, the best companies in the US. In fact, the top 10 companies represent 30% of the index. And let me tell you, they have fortress balance sheets. They are almost like buying the safest thing you can buy. So it looks to me like, portfolio managers have come into this summer saying, I want to own a home that's made of bricks. This house of bricks sort of thing. So I think it's been the safety play, because where else are you going to go? Into a bond market that is losing more than the stock market.
Yeah, it certainly shows that differentiation between those three baskets. I appreciate that very much, Jeff. Your final chart, I want to spend a minute on this if we could. Looking at some Elliott Wave counts, how would you count out the movement that we've seen? What does this tell us about going forward?
Well, I think there's two ways that the market can correct. And there's no doubt we had a 13-year epic bull market advance. And the question is, do we correct a 13-year seven-fold advance with a 24% correction over 8 months? I don't think so personally, but we look at it this way. You can correct through price or you can correct through time. And on the left-hand side, we see what we're calling the preferred bearish count. With bearish momentum still strong to the downside, we think that if we did see a breakdown below the 50-day moving average and we take out the June lows, that could be the beginning of a third wave decline, which could ultimately trace out 5 waves down into our target area of around S&P 2250. That's a worst case scenario. But on the right-hand side, we look at the bullish alternate case. And as you know, the market tends to try and frustrate as many people as possible. And I think it's going to frustrate the bulls as much as it frustrates the bears in this respect. I think it's possible that if we don't get a break to the downside, that we just trace out a lateral consolidation formation over the next possibly couple of years before we're able to make new all-time highs. So in both cases, there are losers, but there's very few winners in either one of these cases.
I can't help but notice, Jeff, neither of these counts involve the S&P making a new high for quite some time. That tells you, I think, a lot about the conditions that we're in. Jeff, listen, this is super, super helpful. Brilliantly done combining these three to tell the story of this market. Stay safe there in Minneapolis. Be well. We'll talk to you again soon.
Thanks, Dave.
That's Jeff Hughes. Jeff is the Chief Investment Officer for JWH Investments, coming to us from Minneapolis. His Elliott Wave count at the end is really helpful. I am not a big Elliottician. I'm not an Elliott Wave aficionado, but I have learned and very much appreciate the discipline. And what I love the most about it is it helps me think. It helps me break out of the narrative I myself have created by looking at my charts and think about some alternate counts. And what was really helpful is thinking about how the markets can correct, as Jeff very well put, in price and or time. And you have to remember, those are two different ways that a market can correct. We've seen that very much in the last couple of years. We've seen examples of both a price correction and a time correction. A lot to think about there after some really good charts by Jeff Huge. Let's continue on today's show with our next segment, Getting Sentimental. Let's look at some market sentiment indicators and talk about what they are telling us about what investors are thinking, what they're saying with their voices, how they're voting with their ballots, and how they're also voting with their capital. We're going to start, however, with the VIX. The VIX is my favorite way to think about sentiment because it really, again, it's called the fear gauge. I'm not a huge fan of that. I'd much rather call it the uncertainty gauge. It's not as catchy and certainly not as headline drawing, but it's a little more accurate, right? Rising volatility basically means rising uncertainty. I've always said the market likes certainty. The market likes stability. The market likes having a good sense of where things are headed. And that really just reflects that investors in general like stability. So if you look at mid-2021, which is a fairly stable phase, we kind of, we're in the midst of, or really coming out of the initial scary parts of the COVID epidemic or pandemic, and we're sort of continuing this learn to live with it period. Volatility really low or fairly low between 15 and 25, and you have this nice consistent uptrend. Remember how brief and how shallow the pullbacks were in 2021. I mean, if we had a 5% pullback, it was huge. Think about how many 5% drops we've had just in 2022 in the first 6 months of the year, right? A totally different environment. And you can see that reflected by how the VIX has gone from a relatively low period of volatility in 2021 to a more elevated volatility in 2022. Now the VIX has ranged between 20 on the lower end and around 30 to 35 on the upper end. If you very simply have sold when the VIX gets to around 20 and bought when the VIX gets down to around 30, overall, you would have done pretty well picking the major turning points in 2022. The reason why I bring that up is right now, the VIX is down to 20. Now, it's been lingering here for a week or two. You can see that the VIX got down to 20, is kind of, stayed right below 20. It's sort of in the 19-20 range for the last week or two. This is pretty much the low end of the VIX, except for, the end of last year, December of last year, we got a little bit lower into the upper teens, but we're sort of within a rounding error of where the VIX has generally bottomed out and where stocks have generally topped out. This is one of the many things that tell me to expect a limited upside for stocks from here, similar to what we heard from my guest, Jeff Huge today, and expect at the very least some sort of pullback to alleviate this period of lower volatility and certainty in further upside. What would tell me that this market is different? Very simply, the VIX gets below 20 and stays there. Period of lower volatility. It's kind of what happened here. If you look in March of 2021, we chopped around and then got a lot lower, and that told us things were different. This was a more extended bull market phase with lower volatility. We're right at that point where I think this we'll learn which of these is going to be the reality going forward. So important chart to watch here, I think, in the next couple of weeks. In terms of survey data, a couple that we tend to follow, the AAII survey is a measure of sentiment from individual investors. It's a weekly survey updated every Thursday. Today's reading, bulls a little bit more. Bears, not much change from last week. So we had 33% bullish, 37% bearish. Bears still outnumbering bulls, which is really interesting to me. That's not been the case for most of 2022. What's interesting, though, is if you look back in 2020, the market actually rallied for quite some time while it was net bearish sentiment. This is sort of a disbelief phase that lasted for quite some time. People were very skeptical of the V bottom or being a reality, right? And remaining in a bullish phase. Eventually, it took about 6 months for the market to finally bite and turn a little more bullish. You can see, though, that the spread has narrowed. You can see that bulls have increased and bears have decreased. So we're very, very different than where we were in mid-June, which is an extreme high of bearish sentiment there. The name exposure index is looking at active money managers and looking at how they're allocated to the equity world. So 64, which is the reading for the current, the current data, basically says the average allocation is 64% to equities. Now, if you look back over time, in general, it tends to be more in the 70 to 80% range on average. That's sort of the median reading for this data set over a longer period of time, over decades. So 64%. A little below normal, but almost to a net sort of an average weighting, sort of a market weighting, not overweight, not underweight anymore. And again, back in mid-June, we're down to around 20%. Talk about a very underweight position in equities. Back, we're almost to sort of a market weight, sort of an average weighting, which tells you, again, while that's improved, it really hasn't gone to a money managers are all in. We're not above 100%, which is where we've tended to be at the end of larger bull market moves. The RIDEX flows have continued to decrease. I have it plotted inversely here because the lower reading higher on the chart tends to coincide more with rallies. You can see how low that ratio was at the end of 2021 when investors in the RIDEX funds were basically owning all the offensive parts of it. You can see how defensive investors were in March and in late May. From there, it's been a steady increase, not to the bullish positioning we were in 2021, still below the lowest level that we saw for most of 2021, which I think is worth noting. One final chart, which would be the put-call ratios. A couple ways to look at this. I tend to look at the equity-only put-call ratio. I haven't spent a ton of time with this one because I think it's most interesting when it's at extremes. So it's worth noting that we're at the lowest level that we've been in the put call ratio for the last 4 or 5 months, right? And the last time we were this low was back in March, April. Now, the lowest that we've been for 2022 was in late March. This actually coincided pretty well with the March rally and sort of that stalled out when the S&P stalled out at 4,600 there at the bottom and turned over. That coincided with a pretty low put call ratio. The put call ratio is actually pretty far above where it was at that point. It's not down to the lower end of where we've been even in 2022. So put call ratio is saying there's more room for bearish positioning from the options market to confirm more of a market top. So it's almost a non-signal at this point, not really confirming or denying what we're seeing with price. That is our attempt to get Sentimental to focus on sentiment indicators. We need to wrap this show and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. Apple. We talked in our market recap about Apple. Again, I think the thesis that Jeff Hughes was sharing is very, very sound. He has a much more negative Elliott Wave counts. I've made a note to think a lot about some of his projected counts that he was showing you. Again, that's what I love about Elliott Wave is that it's forward-looking. I love things like Elliott Wave, like GAN, Fibonacci retracements, other things that are more forward-looking, trying to anticipate what a future path could be, because I like how it makes you think about what that would mean, right? What stocks would do well or do poorly in that environment. And it just helps you think about what the conditions could be like and stretches you out of your predetermined narrative. I definitely agree with Jeff's take that we've had such a run and the S&P is hitting resistance. A lot of individual names are overextended or at key resistance level. Apple is a perfect example of that. I think what Apple would do, given the scenarios that Jeff was outlining, which is we stall out here and start to roll over, would be Apple wouldn't get above 180 for certain, or if so, very, very briefly. The overbought conditions that we're seeing right now would be alleviated, and we would start to see the stock roll over on weaker momentum. Can't help but notice, though, Apple making a new relative high for multiple years this week yet again. Chart number 2 is looking at the energy sector. I mentioned how charts like DVN and others bouncing beautifully off their 200-day moving average, but following through to the upside, making new swing highs. The energy sector was the best performer today, up about 2.7%. So when I hear people talking about inflation is no longer a thing anymore, the market says inflation is gone, I am super not buying that argument, only because I think a rise in energy prices, or a rise in raw materials sort of plays into that. Inflation is still very much a thing, and it could bubble up. It could be reflected in or manifests itself in different areas of the market and consumer behavior, but particularly in energy prices. And you're seeing energy stocks rotate to the upside, which is pretty much a bullish argument for the commodity space. Finally, the VIX. I've talked a lot about volatility regimes. 2022 has been marked with the VIX ranging between 20 and 30 to 35. The VIX is right back down to 20. That plays in very much to the bull or the short-term bullish run is most likely at or near its end. You'd expect a drawdown from here. I think that makes a ton of sense for a lot of reasons that some of which I've touched on here today in the show. But it also tells me that if the VIX can get below these current levels and stay there, that could be a really interesting development and a change of character for this market. For my premium members of Market Misbehavior, earlier today, I shared a note where we're in a lot more detail about particular names that we're running into resistance may be cautionary. Go to marketmisbehavior.com for more info on that premium membership. Folks, that is a wrap for the show. I want to thank Jeff Hughes from JWH Investments. Always does a great job coming on the show and sharing some really great charts that make me think. He also was on our most recent episode of The Pitch, so make sure you watch that at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.